This is Slim's Take. Slim's Take is something that I do, and I think there's an important issue to discuss about the market, and I've got opinions about it, so that's why I bring this to you. And today, Slim's Take is a stock market versus a market of stocks. So the stock market is soaring to historic highs right now, but this strength is narrow, not broad. Techs and AI, they're the giants that are lifting the indexes, while most of the other stocks do lag behind. We've seen that, though there is some change going on in the market at this moment. The few carry the many. Well, the top 10 stocks now make up nearly 40% of the S&P 500. The Mag 7 alone represent about a third of that S&P 500 index. Their valuations are at extremes. NVIDIA, 66 times forward earnings, and that's some pretty rosy earnings. Tesla, 209 times. Apple, Microsoft, both of them sitting around 36 times. This just is an example of some extremely high valuations. If you look at Palantir, well, it's off the charts. This narrow surge is what's pulling the market up to record levels. But there is fragility at the peak. When concentration peaks, well, then risk rises. One earnings miss or a policy shock in the megacaps can ripple across the entire market. Investors think they're diversified in the indexes. That's dangerous. It's a dangerous illusion. With 4 of every $10 tied into the same few names. That is not diversification. And beneath the surface, many sectors remain flat. In the late stage, investors do search for the undervalued. And we do see that now as we begin to see some movement into value stocks, cyclical stocks, as the Dow Jones begins to overperform the entire market. But history, that does speak loudly. Past peaks in concentration have led to poor long-term returns. In 1972, which was when I first started looking at the stock market, investors faced a lost decade. Inflation and the 1973-1974 bear market crushed valuations. The S&P 500 delivered negative real returns for the next 10 years. I can tell you that was the period when investors got so disillusioned, so many didn't even want to look at the stock market. As a matter of fact, if you look at the period from 1968, 1972, whichever one of those peaks you want to look at, there was one in 1970 also, that period out to 1982 had 3 or 4 very significant bear markets, depending on where you measure that from. So there were a lot of times when investors IRAs, their retirement accounts got devastated during that period. So people got very disillusioned, and that's what happened. It's just the opposite of where we are now in the stock market. The 2000 tech bubble, the index produced flat to negative real returns for a decade. The lesson? Concentration creates short-term lift, but often sets up a decade of disappointment. Let's take a look at this chart. This is so interesting. This was put out by CRSP, Goldman Sachs Global Investment Research. And what this shows you is the market concentration relative to the 75th percentile in the stock market. So this, if you look here, this shows 1932 as a peak level of market concentration. And here, 2023, that's the little dot, and then it went up past that into 2025, is the market concentration today. So you can see we've gotten up to this level. Well, you would say, why doesn't that say 1929? Well, actually, the market concentration went up in the first down wave of the crash after 29, because look at these stocks that were the top weighted stocks during that period. They actually were a flight to safety. They didn't go down as much as the rest of the market. Well, that is until the next wave when the market started to fall. And remember, the markets did fall all the way down until they made their low late 30s, early 40s, during the time when the war started and all the money started to get spent to build the defenses, and people all working for the defense departments and saving mass amount of money. And that's actually what got the economy out of the Depression, was when all that money after 1945 started to come back out, and that was the post-war boom that you saw right in there. So when the stock market crashed in 1929, actually the bottom fell out from under it, and the heaviest weight stocks actually didn't quite do as bad until later on. And you can see that list. Now here we are. Here's the list today of these top 10 weighted stocks, and that's the ones that are in this, 40% of the market, 40% of the S&P, and that massive weighting in there. Just one mistake, one accident, one change in sentiment about AI, one sense that the spend that we see going on is just insane and cannot be monetized by all of these companies. Well, all of that, any of that, could be what breaks the stock market to the downside significantly. So that's the comparisons of the of market concentration, and you can see right now we're at a record market concentration. That means, well, what does that mean for you? So my take is that today's market strength, it's narrow, it's fragile, and risky. Investing in the indexes is not equal to diversification. And so many people out there think so. Just buy the SPY, keep it forever, it's just fine. Well, the SPY right now is so heavily weighted in these few stocks that when that first mistake comes, you're going to see there will be massive moves to the downside. Big downside days, big downside weeks, something very different than the market that we're seeing right now. So I'm not saying it's coming tomorrow. I'm not saying it's coming in a month. But when it does come, it's going to be painful. Opportunity still exists, however, but only by being selective in this market of stocks, not the headline indexes. That means you have to be very selective, and you have to be more short-term minded, because if you have that perspective, you will be able to stay out of trouble. The trouble that is likely coming. Well, once the peak comes, probably for the next decade, because history warns, when few names carry the market, the next 10 years rarely reward investors. Ignore the lessons at your peril. That's Slim's take.